you, Simon. Thank you, everyone, for staying to the end of the conference. And yes, it's definitely more fun to be here at 8:30 than at 5 in the morning. So many of you have heard me before. For those who haven't, I'm Malcolm Myers. I've been for 13 years in classifieds. I used to run M&A at Naspers in the early days, have been advisor to Scout24, and I now run my own advisory business, raising capital and doing M&A exclusively in classifieds and marketplaces. And although we're called European Internet Ventures, we actually work everywhere around the world. I'm going to talk today in three sections. I'm going to talk about the challenges which I think many classifieds players are feeling around the world. I'm going to talk a little bit about some of the disruptive models, and particularly those which are getting closer or right into the transaction. And I'm going to end up talking about some paths to value creation that many of the classifieds operators on this call could well be placed to adopt. So first of all, what are those challenges which are facing classifieds? I think, first of all, even before we were hit with the pandemic, growth rates were falling down. We've gone from double digits to single digit revenue growth rates. Companies both in real estate and cars are shown here. But despite that fall in revenue growth rates, interestingly, the market cap of the top 24 players in this space has actually doubled since June of last year, from 150 billion to $300 billion. Now, part of that, in fact, almost over 60 billion of it comes from the IPO of a Chinese giant called KE Holdings, which runs the largest brokerage network and the largest portal. But there's still 90 billion of capital or market cap increase that has come through. And if we try and drill down and see where has that come from, there's some interesting trends. These gold bars are actually just showing the increase, right? Not the total, but the increase in market cap over these past 50 months. And guess what? Top of the list, it's what I would call the transactional marketplaces, like Carvana, obviously the cars, and Zillow in particular, driven by Zillow Office that Simon was referring to a little bit earlier. Secondly, the market cap increase has gone to some of the global vertical leaders, like Recruit or Indeed or CoStar, which is a global leader in terms of commercial data and listings. Additionally, of course, some M&A has also popped up values. You know, everyone's aware of the eBay Ebitda deal and the restructuring and sale of part of the Scout24 group. And then also, for example, OLX, their biggest revenue growth has come from selling cars through Frontier Car Group. So there's been some very important changes and those have been rewarded by the marketplace. Of course, we're all fortunate in operating in very large markets. I won't go into the details, but you know, if you look at the brokerage commission pool, which is traditionally what a classifieds player is aiming for, it's about 100 billion for house sales in the US, about 32, 33 in Europe, probably under 5 in Southeast Asia. I'll be interested to hear if people have other views on that. And then the rentals is also $11, $12 billion business around the world. But even if you're one of the great success stories of the classifieds model, a Rightmove or a Zillow, the classifieds model is only getting a very low share of those commission pools. If you look at, for example, on the left, you can see $16,000 on a $300,000 house, which is quite usual in the US, and just a few $100s being spent on Zillow. And again, on the right-hand side, you can see data from Rightmove. And of course, when we move to emerging markets, and many of you on this call are from emerging markets, we can see that subscription models are really struggling to deliver meaningful revenues. On the left, you can see revenue per internet population for some of the mature markets. Rare Australia, right top of the pack, $25 per internet population. Property Guru Singapore only operations is like a mature market, very good monetization there, and you can see the other guys. On the right-hand side, you have to look carefully. The scale is like 100th. So the top of the scale is now 40 cents per member of the internet population, per internet user. And Zameen in Pakistan is the most successful business I've found so far. And not because they are charging subscriptions, but because they're getting a commission on real estate sales of primary. And the more listings-based players are not getting the same level of monetization by far. And something else to bear in mind is that not every market will produce a clear outright winner like a RIA, a Rightmove, or a Zillow. In this chart, you can see at the upper end of it, these are the vertically dominated markets. And down on the lower part of the chart, these are horizontally dominated markets. And then you can see the smaller markets on the left and the larger markets on the right. So a company like Finn in Norway dominates real estate as a generalist. Sahibinden and Le Bon Coin are also generalists, which more or less dominate or are very, very powerful in the case of Le Bon Coin in real estate. And then at the top of the chart, you can see those successful verticals. Again, Property Guru in Singapore is on the left there. RIA, Rightmove, you can see Zamin, you can see there. And then a company like Bat Dong Sang in Vietnam, 60–70% of the market, again, dominant. But by far the majority of markets are in this, what I call this competitive middle. I mean, we look at China, India, Russia, Indonesia, and look at Southeast Asia bang in the middle. And only very occasionally do you get so much M&A activity, as we've just seen in Brazil, that you can actually bring together horizontals and verticals and create one stronger player. Many of you have seen this before. I think it's important to track the journey of classifieds. Many started off as simple listings businesses, moved into depth products, CRM, promotional listings, and so on. And most now are around, are focusing on ancillary services, trying to make money around the transaction, like through the sale or brokerage of mortgages. Hardly anyone, very, very few, have actually gone right into the transaction. Zillow and Zamin are the two which I talk about here. So is that focus on ancillaries the right strategy? I'm actually pessimistic about how much pure Ebitda you're going to be able to get from mortgages and the like. And here's some examples where companies such as Zillow or RIA are getting less than 10% of their revenues from ancillaries and far less than 10% of their Ebitda, because of course the Ebitda margins are lower. And why are they lower? Well, if you're selling subscription services and you're dominant, you can really have pricing power. Like a UK agent wanting to list has to list on Rightmove or Zoopla. If you're a consumer looking where to go for that mortgage, you are spoilt for choice. So it's really difficult for the portal to extract a premium for bringing that service together. And it's certainly easier to do this if, rather than being part of the listings and search journey, you're actually at the center of the transaction. And I think this brings a very important point, that the traditional classifieds model, in my view, lives off a broken consumer experience. If you think of the ultimate consumer experience as buying a smartphone on Amazon, the whole thing runs off one platform, right? Comparison, information, transaction, payment, delivery, returns, and so on. Classifieds is basically about generating leads. And once the leads have been there, the classifieds model pushes you off onto the sites of realtors who may or may not end up closing a transaction, usually offline. I would add that even before the pandemic, a business model that depends upon intermediaries may not look so strong as we go ahead. They have expensive infrastructure, expensive offices. There is now, especially in a pandemic world or post-pandemic world, fewer opportunities for that relationship building face-to-face, which is often how the traditional brokers have justified their premium. And then I would argue that the large tech-enabled brokerages, which we'll talk about more later on, are pushing down price points and making life tougher further for the traditional infrastructure-based agents. And then finally, to wrap up this first section on challenges for classifieds, I would argue that there's a ton of money. I counted over 17 billion of capital being raised through venture capital funds over the past few years up until April that have gone into businesses which, guess what, are challenging largely the traditional classifieds model. The dark blue bar, for example, is US investments, dominated by investments in tech-enabled brokerages like Redfin, Compass, and iBuyers like Opendoor. And then the sort of the lighter colored bars to the right are Chinese investments, which have been partly in tech-enabled brokerages, but also very heavily also in co-living spaces, these rental platforms that we'll also talk about in a few minutes. So that's a small introduction. Let's take a look at some of the disruptive models in a little more detail. So I think there's basically two types of model that I'd at least like to talk about today. One is the property sales focused models, and the second is rentals models. The property sales focused models probably fall into two parts, ones which are challenging classifieds and ones which are more cooperative or more optional for classifieds to engage in. So on the far left, clearly the iBuyer model, we've talked about it already today, companies like Opendoor and Zillow who are actually buying properties in order to then find someone to sell them onto later on. Secondly, we have the tech-enabled brokerages, ones which are trying to industrialize and bring scale to the traditional role of the agent. And I think they are a very interesting space to watch as they become more and more like portals in their own right. And thirdly, we've heard a lot during the course of today, the commission sharing models, companies like McCann, for example, where the platform is working together with agents, tracking those leads, and when the leads go through to completion, then the portal is getting a share of the commission. Also, the majority of the models I've seen are in Asia. In Europe, we have Tapu.com in Poland and Prontopiso, for example. And then finally, we have the portal direct sales, again, spoken about today. They are particularly focused on selling new builds. They have their own direct sales teams, and some of the successful ones have already been on the call today, including Shui, Square Yards, and GUI. And then finally, I'll talk about rentals a bit more. Traditionally, rentals have been underlooked or undercared for by property portals. We now have some very successful rental-specific portals like Zampa, but more interestingly, we have some more transactional-based rentals platforms like MoveBubble in Europe and Quinto Andar in Latin America. And then finally, we have these co-living platforms, which we'll also talk about in a few minutes. So let's take a further look at some of those traditional models who are competing with classified operators. So iBuyer, I think what's great is if I'm a consumer, I want to sell my house, it's a wonderful experience, right? The iBuyer takes care of everything. I don't have to list on a portal. The weakness is clearly that these models are hard to scale. They're grossly capital inefficient. If you're a consumer, only roughly 1 in 50 consumers who ask for an offer actually get one. These businesses are all grossly loss-making. And by the way, in terms of market share, they get a huge share of mind in terms of space and headlines and capital raising. But in the US, for example, last year, over 6 million homes were sold. Less than 1% of those homes were then sold by iBuyers. Interestingly, Zillow is the only classifieds business I have found which has decided to branch out into the iBuyer model. It'll be interesting to hear if there are any more examples. Secondly, the tech-enabled brokerages, or TEBs as I call them, I think are really interesting. They are clearly able to generate commissions. It's similar to the commissions of traditional agents, but they have the economies of scale. And because they're building out their own online presence big time, they tend to get network effects as buyers bring sellers and sellers bring buyers. They are challenged initially by having low traffic volumes, but with sufficient capital, they can bring that up into a scale. And yes, they can have very high customer acquisition costs, again, until they have reached scale. They don't have that wonderful benefit that portals have of having buyers and sellers on the platform since ages and ages. And of course, if you are a portal, tech-enabled brokerages can be great customers initially, but unfortunately, as they get bigger and bigger, they will probably need those portals less and less. And I think Redfin is one of the most successful and largest tech-enabled brokerages in the US. They are now a top 100 similar web in-country sites. So Zillow, okay, is probably top 20. Redfin's already in the top 100. Then let's look at some of those cooperative transactional models, which are more cooperative. Portal commission sharing, we've talked about already. It means that, and especially in emerging markets where listings are not generating much money, you have higher revenue per listing. You can attract brokers who are unable to commit to subscription fees. It's very well suited to non-exclusive markets. Again, tons of those in Southeast Asia or across Asia overall. What's tough about them is you need leads attribution, we've heard about, and many brokers won't like it. For classifieds players, I think this is a really, really interesting model to look more into detail. I think the pay-for-performance model highlights the value which portals are bringing to agents. And one perhaps less combative way to get into pay-for-performance is pay-per-lead models. There's an excellent company for example, in Ukraine, in Europe, which recently moved their entire agent base from subscriptions to pay-per-lead. And just doing that, even before bidding for different leads is really working at full speed, they've already increased their revenues by over 35%. And then finally, let's talk about portal direct sales. I think Zoomine is the best example I can think of. This is a $1 billion company now, the core business of which is this highly structured sale of developer inventory. A lot of it's based upon live feeds. You can almost see how many other people are looking at the same property. You have almost gamification in there. This is working very well and definitely to be looked at. So that's on the sell side or the buy and sell side. Let's look at rentals. Rentals, as I said, have been totally overlooked. I think there are three different models to think about. There's the classic classifieds model with lots of listings generating leads for agents or for landlords. Companies like Zampa are a good example of that. There's the marketplace model where you have many buyers and many sellers, or more specifically, many agents and many landlords and many tenants. And the role of the platform is to connect the two together. Examples like MoveBubble in the UK, Spotter Home across Europe are examples of that. And then finally, there's the platforms where the main difference is the inventory is either owned or in long-term lease arrangements by the platform. So a Residently or Z-Rooms in China, for example, who by the way also has a marketplace, but they're also doing their own leased properties. And if the platform also effectively owns or has control of the property, they can obviously manage that full consumer experience in much more detail. And I'll explain some of those benefits shortly. So that, if we think of that, that experience going through an app on a platform, it's what you'd expect it to be in terms of the quality of the imagery, the video run-throughs, the ability to apply for that place actually on the app. And also there's a lot of the sort of post-contract follow-up that you can communicate for maintenance and other issues. So a 21st century experience, I'd argue, on an app. And then, as I mentioned, some of the marketplaces are able to offer most of that, and a company like MoveBubble would be a great example of that. So if we go back to that Amazon experience, again, I think both the marketplace and rental platforms are able to offer much more of that end-to-end experience than we've hitherto seen. And as a result, they can generate more revenue. But although they're generating more revenue, are they able to generate more Ebitda? Well, the simple answer is not quite yet. I'm trying here to, to give examples of the kinds of economics you can expect. Classifieds model, maybe you're getting an average $20 per listing if you're operating well, and maybe 75% Ebitda margin. So you're getting $15 of Ebitda for every rentals listing. If you're a marketplace starting from scratch, you've got your landlord acquisition cost, you've got your tenant acquisition cost, and you've got to run the business. I have not yet seen a single rentals marketplace that is making money currently, but I would expect at scale them to be able to make $50 or $100 or more dollars per contract. And then the platformers, who again have the benefit of having a long-term lease on the inventory, are offering more services. They tend to get longer leases, and that means that their initial revenue is usually higher, and their ultimate ability to generate profit is probably greater, although in the short term, unfortunately, their ability to generate losses is also higher. And Danker Apartments, for example, a Chinese player, are recently listed. You can see their numbers. They lost last year $650 per unit rented, and this is over hundreds of thousands of units. But I firmly believe this model will scale up and start to become profitable. So those are some examples of what's been going on independently. Now, you as portals, as classifieds businesses, here are some examples or ideas about paths you can take to value creation in this post-pandemic world. So first of all, let's look at the homes business, home sales business. Strategic options would be one, classifieds 3.0, which is where a lot of you are today, but plus improve virtual tours, get into the conveyancing, that helping to facilitate the actual transaction part through providing, for example, a conveyancing marketplace. And perhaps very importantly, why don't you look at some of these new fintech products like we've seen from Orchard or Ribbon in the US, where you're helping to bridge between when a person can sell their home and when they can buy their new one. I think that's a great way of adding a lot more value if you can structure it and obviously have a third party take the funding risk. In such a model, of course, the role of the agent is largely unchanged, but I think there's a significant revenue upside from those financial services. The second model, which is more innovative, and I'm just seeing the first examples of it today, is the Shopify model. Remember, Shopify helps traditional e-commerce businesses, or sorry, traditional bricks business, physical retail businesses become online businesses by providing them all that infrastructure they need to have an online presence and for their whole e-commerce stack to work. So think about doing that in the real estate sales side. You could create a whole transaction service, a whole deal room that helps the individual to monitor that process, to walk step by step through the transaction. And clearly you can do it in a co-branded way with agencies who would be perhaps on a SaaS model, taking the service from you, but obviously the agency would be seen to be the partner in that transaction. So the role of the agent, it perhaps doesn't change that much. I think you can charge them much more money as a result of providing the infrastructure. And by the way, it gives you a ton more insight into actually, a ton more visibility into when leads are actually resulting in transactions. And I think that again provides a revenue upside for such a portal adopting that strategy. You can get glimpses of this working in Europe, for example, by looking at Pronto Piso or Wando. And then finally, and I think probably more controversially, why don't you as a portal set up your own tech-enabled brokerage? After all, they're here anyway, whichever market you look at, certainly in Western world, and I think we're going to see some also across much of Asia, you're going to have these really powerful agency groups, many of them without a fixed infrastructure, building up their own web presence. So especially in markets where there's a highly fragmented set of smaller agents, why not create your own in-house brokerage? And that way sellers can either choose to go to the traditional franchise agents or use your own in-house brokerage. Clearly that then gives us a material revenue upside for the portal. And the traditional agencies, the franchise ones in particular, they would still use your site for all the leads which they have today and would still be able to have an effective partnership. I know it's not the easiest thing to bring about. I think we're going to see it happening. And of course, such a model will give a lot of upside to the portal, especially if you could package with fintech. And then, of course, rentals. The obvious thing to do here would be to move from a traditional listings-based classifieds business to more of a spotter home move bubble business or Quinto Andar business. Of course, there's a halfway house. You could help to digitally enable intermediaries. You could help to book virtual tours, provide tenant passports, deposit insurance, all within a more traditional classifieds environment. That's one role, one model you could apply. I think the more gutsy, but again, a much more high return approach would be to go from your high trafficked classifieds listings business, take that traffic and push it into a end-to-end rentals marketplace where you take care of high quality listings, verification of those listings, and managing the whole transaction through to the end. And if you do that, you'll be able to raise your profitability without having that initial loss-making phase, which the startups are having. And so that would, I think, result in a step change of the economics. And again, companies like Quinto Andar in Brazil are really doing this big time at the moment. So that's all I wanted to share with you. I think in conclusion, for classifieds players, a continued focus on subscriptions and sales of ancillaries is unlikely to deliver those expected returns which financial markets have of your businesses. And to reignite growth, classifieds players will need to either evolve into fintech plays in partnership with intermediaries through sales, for example, or launch their own tech-enabled brokerages or become rentals marketplaces. And I would argue that the upside from this meaningful commission share or revenue share is far greater than the potential downside of annoying a few agents. That's all from me. Thank you very much for listening.
Malcolm, thank you for that. As always, fascinating to hear how you view the world, and how what's actually quite fascinating is how those views have morphed and changed over time and grown as we see as sort of this thing's happening in parallel as the industry is evolving and shaping, and how you think about it, I think is helping provide advice and guidance for a lot of people. There are some questions that have popped up, which I want to ask you while we have a few minutes. Are there players who have done well in creating ancillary services, sources of revenue, e.g. home furnishings, movers and packers, and so on?
I mean, the answer is, if your core business is building up a leading real estate portal, then the revenue streams and profitability of that core business, which is multi-billion commission market in any country, should be a far greater source of profitability than getting into movable services. And I think there are plenty of startups in the movable services space that have burnt a lot of cash and fallen apart. So I would look very carefully at the history. Companies like Immobilien Scout have been, incredibly successful companies, got in more than 7-8 years ago into everything around the transaction. And today, 70-80% plus of all their revenues are still coming from the listings business.
Yeah. And in fact, I think if you were to unpack all the major successful players, it's pretty much the same story. And if you look at the realestate.com.au, not the REA group, but realestate.com.au, the majority of the revenue still comes from the same, probably half dozen products, which are all basically advertising products, the base subscription plus then premium products that sit on top. Rightmove is the classic example where they're still selling the same stuff they were selling 15 years ago in reality.
Price is different.
Oh, the price is a lot different for sure. That has gone through the roof. As it's like boiling a frog in that whole process, right? The frog being the agent. And what's happened is that's just grown progressively over time. Each year the price goes up. So I think when you start to unpack it, whether it's ImmoScout24 or Cellular or whatever, the story is always the same. It's that core business, dominating the core business, pricing increases and bolting on a few ancillary products, but these ancillary products are very closely related. So you've got the base subscription product and then a premium product sitting on top just to make the listing bigger or bright and shiny and in theory getting some more clicks or some more visibility. Yeah, I think in that process. Another question around around the transaction, finance seems to be getting a lot of US private equity attention, such as Riven, Flyhome, Zero Down, Divi, Noah, etc. What's your view?
So I like to make a distinction between the pure iBuyer models, where the balance sheet has to acquire the property and then sell it, and the more fintech-focused platforms. Orchard's a great example, which are trying to fix that problem that I need to buy a home before I've managed to sell my other home. Yeah. And with enough scale and enough data, these companies will rarely end up owning anything on their books for very long. So I think I like the model. I think it has huge returns to scale and focus, and scale often is relevant within obviously a particular metro area or market, because that's usually where the buy and the sell transaction are taking place. So yes, I'm excited about it. They're not all going to work out. I think, but what I find fascinating, that's the point I made towards my conclusion, is I think no one has better data on how likely a property is to sell than the portals themselves, right? So why don't they get through partnership into these kinds of businesses themselves?
Yep. And I think we had Sean Black from Knock present at the Global Online Marketplaces conference back in June. And if you want to go and see a good presentation, you should go see that video. For anyone out there, I think it's good to hear about how they approach it, how they've done a lot of things to de-risk themselves and not end up, as you said, holding stock, which at the end of the day is what you don't want to do. You don't want to have thousands of properties on your books, especially when the underlying movements in the markets, and especially if you think about being in the US, you've got an election coming up, you've got Supreme Court issues, you've got a whole range of issues. You just don't know what's going to happen with housing prices. And I'm sure if you bought a whole bunch of stock in a certain type of market in late 2019, and now everyone's wanting a different type of house, then there's danger that those properties have rated down, or may have gone the other direction. There might be in attractive areas if you've been fortunate, but there's too much volatility in some of these markets.
It's rather more risky than the subscriptions business.
Much more risky than subscription business, for sure. Malcolm, thank you very much. Always a pleasure to have you present in these conferences. Fantastic insights as always, and I'm looking forward to having you at our next virtual conference, which is coming up in 2 or 3 weeks' time. I think it's a couple of weeks or so, for the European market in a time zone that's far friendlier.
Thank you, Simon, and thank you for putting together the conference today.
No, thank you for participating. So.